the layperson or the common man, who is, by common I mean individuals who are not really connected with the markets, underestimate how difficult the process of decision making in the market actually is. And the fact is that in the market, while you are only buying and selling, you're doing this so often that the psychological implications of those decisions, the decisions which are so critical, which will impact your financial health, the psychological implications of them are quite intense. And often individuals underestimate the mental stress that a trader would be carrying. And consequently, in order to alleviate that stress and in order to be able to perform at your peak potential in the markets, individuals are required to prepare and plan for the trades. So, at the expense of sounding repetitive, the idea is that we will analyze the market, the price action as it unfolds, to have a clear view of the market. And even if we get a trade in the direction of the market with the view that we form or not, our general approach in the market will be governed by the assessment that you do on the broader indices. In other words, even though the chart that is under description or under cover here is that of the Nifty 50, Nifty 50 itself has 50 other stocks. So if you end up having a bullish bias on Nifty 50, then of course you can take that bias into other stocks and repeat the process there. I would like to start the video today with a few questions that were asked by some of the, I think, subscribers or at least individuals who left comments behind. And the first question, I think, is from Omkar. You all will remember that a few days ago we had drawn two horizontal lines. I'll just mark them here. This is at this point of Nifty, and that is, you will see this particular point of the index. That is what we were seeing. And these are close to around 4 trading sessions, 3 to 4 trading sessions or maybe more, where the index was behaving very choppy. And we had correctly identified it that the index is not trending strongly out there, and consequently we decided to trade the index like a range. And the approach suggested to trade the index as a range was simply to sell 22,600 CE. This is a reference of a video of last week, maybe 22,600 PE and 22,300 CE and 22,300 PE. That was the intention of that was the plan of selling the options, because what we had discussed is that with the ADX value comfortably below 25, the index is ranging, and the plan is to short the extreme points of the range, so that if the index closes between these extreme points, both the call and the put option will lose value, giving the trader a profit. And of course, it was discussed in that video that since these are the highs and the lows of the range that we have identified, any price action above that will simply mean that we will not be taking this strategy forward, because once the range is broken, we are looking for a confirmation if the market is trending or not, and accordingly our plan will also revise. So now the question that Omkar had asked was that I recommended selling 22,600 CE and 22,300 PE at the time, and I had also recommended that this action needs to necessarily be taken at 22,450 levels. The reason why I had recommended that is because we need to have a clear plan, we need to have a clear value in which we are going to act. And if we are putting the market in a range, then the market is very likely to test the midpoint of the range, because market is by definition in a range. And therefore I had recommended to hit that order at 22,450, recommended it to those who were looking to trade the market as a range, and recommended it as a matter of practice, not as an advisory call. So the question that obviously came is that if hitting the sell order of the extreme points was for 22,600 and 22,300 at 22,450, then why not simply sell the 22,450 call and put at exactly that value? That was the question that was asked. And to this, I hope that individuals who have some experience trading the market would be able to appreciate the question that is being asked here, that even this strategy of shorting the same strike at the same price works best when the market flattens out. And even the strategy that I had outlined earlier, that is shorting the extreme points on call and put, works best when the market flattens out. So both these strategies are actually working best when they're flattening out. Then why did I recommend the first over the latter? Or simply why didn't I recommend the latter? And here I will answer that. I have obviously answered that question in the comment, but I thought that it requires a little bit more explanation. And so first all is the approach is perfectly right. That is, there is nothing wrong with the approach. It is theoretically, it's a very consistent way to approach the market. You have put the market on a sell, you expect the market to close at a midpoint of the sell, and consequently when you find the market at the midpoint itself earlier in the day, you will short both the call and the put of the same strike and hope for the best. Of course, your stop loss would obviously still be 22,600 and 22,300, which means that under no circumstances should the in the money value of either of these options exceed 150 points. So that would we would be carrying forward the same trade logic. The only difference is going to be on the instruments that were selected. And to this, I would like to answer that the difference here outlines the difference in the approach. When I am writing options, firstly, I am not writing options, we are only discussing for practice. But when I am writing options, the sole intention of doing that is to make money in a stress free, comfortable environment. And whether the market is at 22,450, whether it is here at 22,550, or whether it is here at 22,380, under no circumstances either of my call or put options are becoming in the money. Once again, regardless of where the market gets itself into the range, under no circumstances are the selected options getting into the money. And if they are not getting into the money, then obviously any and every time the market flattens out, these options are going to lose value quite fast. Whereas when you write 22,450 CE and PE, you would note that under almost all points, either one of these two options gets in the money. And when the option gets in the money, the erosion of premium for that option becomes slightly lesser. But that is not the reason why I suggested it. The reason why I suggested this is because suppose you have shorted options which are at any given point, at least one option is in the money. Just imagine the impact of a bad news in the market or the impact of a good news in the market while your trades are open. The thing is that the market can simply take off by a couple of trading ranges, ATRs, within in a very short point in time. And when that takeoff actually happens, these in the money options become very there is obviously the delta that you have to worry about, but there is a greater issue of the gamma getting played because of these in the money options. So my point is that I prioritize safety while writing options, because there is simply no scope of ever making a lot of money by writing options unless we are doing this again and again and again, and unless the market repeats this pattern again and again and again. And it has been my experience that it is simply much easier to leave such a market and choose another stock rather than trying to specialize or build a core competence around option writing. And also my experience on social media and other places, when I've seen option writers with thousands of lots showcasing profits, I find it very amusing actually. And that people who do not understand that it is a strategy that is designed to give shorter term profits, it is expected for that strategy to give small profits. So to I don't see what's there so much to appreciate. The appreciation of an option writer actually happens in the discipline of not carrying forward an option, and in the event their option ever opens against them or trades against them, then in such a case the plan is to exit the option very quickly. It is this discipline that actually differentiates an option writer, a successful one, from a losing one. Obviously discipline is an edge even for option buyers, but that is my point, that if an option buyer becomes disciplined, he has or she has the potential of earning a lot of money. But whereas an option writer, if they become disciplined, they end up having the potential of saving a lot of losses in the future. Therefore, I, while writing options, suggested the more conservative value rather than the slightly more aggressive value of shorting the same strikes. And I hope that I hope that even though we have not yet discussed the plan for tomorrow's trade and things like that, or assess the market yet, but I hope that in this, through this Q&A, students or other traders who are actually trading the markets begin to appreciate that how much of decision actually goes into selecting even the correct strike price at which the trader is going to work. And often the selection of strike prices itself gives you a lot of assessment of what is the trader's view on the market. So for example, if I were to ever have a screenshot which would show a sell on 22600 CE and 22300 P, the the person who's seeing that screenshot need not be excited by seeing the profits. They simply need to understand that at that time the trader is saying that the market is in a range. And similarly, if this is the screenshot that is 22450 CE and PE are written, the view is exactly or could be exactly the same, but such a trader is slightly more aggressive and more ambitious in their approach to the market. So yeah, so this is, for some reason I do not know why, whenever I try to record the video, only then will people call and send me a text message. It never happens almost throughout the day, but every time I sit down and think, okay, I'll record the video, and then I'll have a series of messages and WhatsApps and everything will start coming right at that time. Anyways, ignoring all of them and going on with the recording further. Another question that was asked by Ankur, who I guess is from Jammu because of the surname. The question that he asked is, please talk about gaps. And I want to say this to all the viewers on not all, like there are not too many of y'all, but the few of y'all who watch this, is that I believe that the fear of gap is the most is simply the most exaggerated fear. It is just simply unreasonable to have that fear. You see, if you're trading the Indian markets, which only operate for 6 hours a day, then gaps have to be assumed by the trader. To have a trading plan which fears gaps, and instead of thriving in gaps, to have that kind of a trading plan in itself only sets you up for failure in the Indian markets. See, this is not Forex or this is not Bitcoin, where the markets are open for almost throughout the week or 5 days a week for 22 hours a day or something. The stock market in the country operates only for 6 hours, which means the most critical price action actually happens around the gaps. And the only reasonable way to profit from gaps is, first of all, to stop fearing them. By fearing them, I mean is to simply incorporate a trade plan where you expect them. So, and you expect that they will go against you, but then you have to also expect that they will go for you if you are consistent. The key is being consistent in how you are assessing the market. Because if you are actually consistent with how you are assessing the market, in the law of large number, only then the law of large numbers actually kicks in, and you get rewarded in direct proportion to your consistency and the merit of your trading system. But if you change everything so often, basically by starting from scratch every day, by changing the indicator, by changing the setting, by changing the time frame, by changing the general strategy and approach to the market in terms of position sizing, instrument selections, quantity, you are repeating the process of being a beginner again and again in the market. And the only thing that you will end up learning from this are a set of things that actually do not work for you in the market. And I think that in the process of doing that, given the current lot sizes, margin requirements and everything, most individuals are going to lose a lot of capital in the process. There is very little in the way of support that comes from the exchanges in that regard. They have taken, I would say that the recent phase of Madhabi Butch in SEBI has to be the absolute worst phase in a from a trader's perspective to be in the market. There have been very few SEBI regulators who have done so much damage to the industry of trading as this one person, or the team of this one person who have made the suggestions that they have done. It is truly questionable of what they have done, and what, by associating trading with gambling, and by holding it accountable for the losses of millions of people in the country, what they have truly done is actually shut shop for people who are looking at this as a career, and for people who had the maturity to approach it as not as some place to make a bet or speculate or gamble, but rather a place to find the most efficient leverage. You know, if you ever set up a business of your own, even if it's a very, very, very small business, very small scale business, I can't even think of it. Maybe it is something like um, maybe like a tea stall, a very low budget tea stall, that kind of a business I'm saying. Not even a restaurant, but restaurants are very expensive. But even a very low budget tea stall, the risk that you take is huge. You risk the whole property process of leasing it out or renting it out, the electricity bills, the fact that your own staff could steal from you, and the only margin that you actually end up getting is by your physical presence in that business, if at all you end up getting. And then there is this continuous risk that you set up shop and no one visits it. So this is basically what has happened to traders who became traders full time. They became traders full time. They set up shop, and now no one visits them, because traders who became traders full time are now associated as being punters or gamblers, and individuals who are promoting the get rich scheme, which is which I feel is which I feel to have that as a opinion for everyone is just obviously stupid. And the decisions that they have taken have been to really kill the market. So now, because of that, what happens is that the message that is of real key is not really shared. And in my view, anyone who's just looking at the Indian markets, if they are not, or if they are fearful of gaps, I sincerely feel they should never trade the Indian markets as of their in their current form. You cannot trade a single Indian market in its current form, because even the commodity market, which is open for almost 18 hours, which is open for a significantly longer time from 9 a.m. to usually, let's say, 12 a.m. in the midnight. So, which is open for like say 15 hours. Even there, you cannot 6 hours of market closing could result in an absolute devastating gap the next day. So, Indian traders, if anything, need to become highly skilled in managing gaps. Actually, that will be the difference between us and our American and European counterparts who see a continuous market. And when you're seeing a continuous market, believe me, trading becomes much, much, much easier. So it is my view that in its current way, the a trader with an Indian who's trading the Indian markets in its current set of circumstances, let's say you give them 10, 15 years or whatever time frame for them to get adjusted, get used to it, and make a lot of money. These traders will be more skilled than their European counterparts, because when these traders move to those markets and see a continuous market where there is no gap, those markets become much safer to really take on leverage. And it truly, if you know how to control your risk on the downside, that is, you are the kind of a person whose word is as reliable as the rising sun, so you know it, agar bol diya to ye karne hi wala hu main. If you are that kind of a person, you will simply not be afraid of taking leverage, because the potential of gap all of a sudden is very low. What would be the gap in a euro USD or in a euro CHF kind of a security? It's almost negligible. I mean, a person can take so much of leverage at such low cost and trade a security according to its volatility. So I'm very confident that this experience. So first of all, talk about gaps I will in a bit. But since these topics are things that I think I get a little bit. I mean these topics are something that I actually I feel a little close to these topics, because they impact how I approach the market. So yeah. So the point about gaps is gaps are the difference between you and excellence. if you fear gaps, you are going to be a worker in the market for the rest of your life. But if you accept them, then in that case the success potential is unlimited in my view. And let's just have a look at a few gaps that we see here. So I'll just make a horizontal line here, I'll make a horizontal line here, I'll make a horizontal line at this point, and I'll make a horizontal line at this point. So the horizontal lines that I have made are actually the lines that are representing gaps in some way or form. So for example, this portion here is representing a gap, this portion here is representing a gap. And the thing that I want to say is the points at which the market gaps, the regions, that is say 22,500 being a region at which the market gaps, these are highly sensitive points in which the market, the trading activity of the market in a gap zone needs to be looked at very, very critically. I don't want to encourage or maybe drive the lead the traders into thinking that we are in the business of predicting, because that is simply not true. Therefore, I try to keep my presentations away from predictive statements. But obviously, in your mind, you are making a certain assessment of the future price movement, and those assessments that you make are actually, gaps are one of those reasons. So, for example, just if you recollect, when we were preparing for the longer weekend, I had mentioned that the market, when it gets into a range, which is the period that which is the where we address the first part of the question, 22,450 CEP, when the market gets into a range, the break is likely to happen in the direction of the preceding trend. And the preceding move, the move preceding the range, was actually from 21,900 to 22,650. So consequently, this is almost a 750 point up move, after which the market gets into a range. And because we are preparing for the long weekend, and the fact that I'm seeing that where it is ranging is actually the previous gap region, which I did not talk about because you cannot talk about everything, but I did not talk about it because I also did not want to overwhelm the analysis. It actually makes a trader who has a carry forward style of trading, like a swing trader or a positional trader, it makes them alert that this is likely to resolve somewhere in a decisive manner. And the direction in which it is likely to resolve is obviously, like I said, the preceding direction, which is up. And if I can see that preceding there is a 750 point up move, then I would expect that there should be another 750 point measured up move in this direction in the future. So which means if the break actually did happen from this 22,500 or whatever level, then 23,250, 23,350 would obviously be the internal dialogue that would be going on in my mind. But this internal dialogue, like for example 23,250 will be a target of Nifty. If I were to trade with this internal dialogue, then the best trade would be to sell 23,250 put. That would be the best trade on Nifty. You're shorting the put option, and that means you're going long on the market, and you're shorting a deep in the money put option because you're giving the market that kind of a target. And what you are saying is that after the range break, market has that target 23,250, and therefore that put should expire worthless. And that 23,250 put a couple of days ago would have to have been worth at least a few thousand points on the index. It had to have been worth that much, and currently obviously it is taking a real beating. But like I said, that I did not want to articulate it because I do not want to trade that. I know of successful traders. For example, I don't know if Shubhashish Pani is still successful. I mean, every trader has their phases. But I know Shubhashish basically shorts deep in the money options because he wants to have that slightly extra edge over a futures trader, which I personally do not agree with. And therefore, I will long or simply sell the future. I will not do it in the options. But that is my point of view. So there are traders who do that. There are traders who trade like this. So they're thinking like this and they're trading like this. What I want to teach is, or the message that I want to give is that it is my opinion, and a firm one at that successful traders, the best traders in the world, do not predict anything. They simply plan and they take a decision accordingly. So coming back to the topic of planning and decision making, the let's look at the price action as it unfolded today. After yesterday's comfortable green close, the market again has closed up higher, and obviously we know now what this will look like in our indicators, but we will follow the process. And before we do that, let's just have a look at what the trader would have seen internally in the day, because yesterday we discussed about multi time frame trading. So I'll just a multi time frame trader would necessarily have, I'll just shift myself here. I have put a 15-minute chart. So a multi time frame trader would be seeing the day like this. This is the open of the day. Now we have already discussed that our bias would have been long, so consequently we would, on the 15-minute chart, which is 1/4 in terms of time frame of the 60-minute chart, we would set it at RSI 4, and this is the yesterday's close. If you remember here, this is the yesterday's close, and we saw that the RSI was highly overbought. We want to buy this, but we need the RSI to get highly oversold for that process. So obviously this trader would wait for RSI to become oversold, and as the day goes by, this trader tracked the market for the entire day but did not find the RSI getting oversold, which means that the stock, I'm talking about the multi time frame trader, we will see that the single time frame trader also did not get traded, which means that despite having a clear assessment, despite the market going in that assessment, despite the individual setting time aside and tracking the market either physically or by setting up a notification that if RSI 4 hits below 30, give me an alert, or hiring a dealer, taking the cost of hiring a person just for this particular process, still would not have found the trade in the market. The good thing, of course, is that RSI is obviously, we can see a negative divergence as far as RSI is concerned. On the 15-minute chart, we will see price is creating new highs. And RSI is not creating new highs. So this trader would obviously be hopeful that there could be hopefully a minor sell-off in the open. The RSI will get oversold, and unlike today, perhaps tomorrow they would get traded. This is the hope that a trader would have, because it is very frustrating, of course, to see the market just move in that direction and you are nothing but a spectator. The intention of starting this off with today's price action or directly on the 15-minute chart is to give you a closer view of what a multi-time frame trader would be seeing and how they would be approached. That is, once the view is formed, they don't look at the trend chart again. They are simply waiting for their trade to get triggered, which means on the day of trading, on the day they are going to create positions, they are just looking at maybe 1 or 2 time frames. The assessment on the trend is already done in advance and they are not repeating it. They simply have those critical values either memorized if they are just working on 1 or 2 charts, or they would have neatly noted it down on either a pen, paper, diary, or an Excel sheet, whatever works for them. Excel sheet works for me because I physically copy paste these orders that I actually write, and I just put them there so that I don't make the mistake of values often. Any which ways. So just coming back now to the hourly chart. Of course, in the hourly chart, we do not want the RSI, and I will remove, and you will now begin to see how these patterns shape up. See this. This is such a inverted. I mean, it's not an inverted head and shoulders. I mean, exactly, but you can see how the saucer. It's a very unusual handle, but a saucer handle kind of a formation, which is a full-on pattern. And this saucer high is 22,670. The saucer low is 21,960. Roughly 700 points, and therefore from the saucer high roughly 700 points till 23,300 it has a target. But what can we hope for? What cannot by be hope means we wouldn't care, but what someone who's looking to enter would hope for, that there is a pullback and that pullback holds. So let's come back and repeat our process of analysis. We have the chart set up on the hourly, and the first indicator that we're going to set up is the ADX. The ADX is comfortably above 25. Those who would like to know what is our bias above 25 should watch the previous videos. So we are seeing ADX above 25, which means I'm going to include the moving averages. I have selected the 2050 moving average. I am seeing this as a potential entry now we're talking about a single time frame trader. This as a potential entry. right here, which means 22,725 and 22,575. There is a 150 point gap, which means that either the trader enters at 22,725 or 22,575, or simply comes somewhere in between at 22,650. That is, go one lot at this value, one lot at this value, to average it at 22,650, or simply put both the orders at 22,650, or simply go for the first order and ignore the second one, or along those lines. So these combinations exist, and these combinations need to be optimized by the trader. The next step is, once I have my entries known on the single time frame, I obviously need to know what strike price, what option, which is only going to come from my SL. So I'm going to add the average trading range, and the average trading range on the hourly time frame is now 65 points. So I'll come back to this chart here. I can see 22,000 roughly 575 is where it is. So 22,510 becomes my SL, where incidentally this line is already parked. And if 22,510 becomes my SL, logically the trade plan becomes 22,500 call. We would want to buy, that is long this call, 22,500 at, so the levels are 22,725 spot, 22,575, and I'm just writing 22,650 as the single level, which if a trader would want to enter. The exit obviously would be the lower moving average, that is 22,575 minus the 65 points, which means the SL would be at spot. So this is obviously, these are all spot levels that we are doing. Spot means the security we are assessing. SL would be spot 22,510, which means the option would have a minimum, would have an SL, a physically placed SL of at least rupees 10. Now it depends on which period strike price you take, which means you take tomorrow's expiry, that's the Thursday expiry itself, or you take a couple of months later. That much time value needs to be added to that SL plus the time value, which means the 10 points is going to be the intrinsic value plus the time value which you will add at the SL. And with that, we would know that this is going to be our entry, this is going to be our exit, and this is going to be our strike price. The strike price is obviously going to be 22,500 CE with an SL of rupees 10 plus time value, and they will trigger at these levels in spot 725, 575, or simply choosing a mid value of 650, and you would exit them at 22,510 at spot. And that is a simple trade plan. This would be the trade plan of a single time frame trader. The multi time frame trader would of course start the day with opening the 15-minute chart, wait for the security to get oversold, and then look at the 5-minute chart for a breakout, and then enter that particular trade. And their plans could become very diverse, very interesting. That is where creativity in your trading starts coming into play. But this technique is definitely easy, and it does trigger quite often. It will trigger at some points. For example, just in our own recordings, we have seen that here it traded, then here again it traded, but it never really broke the 1 hour ATR below this average line. And it's not to say that it cannot break. I mean, it can break. Like for example, here it did not break, but it can break, and at that point we will have to book the loss. If there is a concern, or if the loss seems too large to take, then that is the whole point of analysis. You know that you should not place the order tomorrow. So with that, I hope I have reinforced our method of assessing the market. I have also addressed a few queries that are there, and I hope that this video contributes in increasing your understanding in some way. Thank you for your time.